What's up, guys? Welcome back to the channel. Today the stock market had a big day. Chairman Jereome Powell came out and gave a 75 basis points hike, and that is something we expected. However, it says central bankers also penciled another 125 basis points hike by the end of the year, so probably a 75 and a 50 basis points hike still to come. I did listen to the whole meeting. Here's a couple things that I thought was pretty important. See here, the federal funds rate down here is 4.4 now. In June, they thought it would be 3.4. So I think that kind of freaked the market out a little bit. Up to 4.6. That's how you get the other 125 basis points priced in there. And the change in real GDP down to 0.2% compared to 1.7. That is also, in June, they thought it would be a 1.7 GDP, but now the thing is just a 0.2. So that's a pretty big change. Unemployment rate, I know they want to get it up to mid fours. I think it's going to go a little higher after all these basis points. They're going to go into a recession a little higher than that. So I do think that unemployment will be like maybe like 5.5 or 6% even by 2023. These are some of the graphs these are a lot easier to see, I think. So I like to look at these. Change in real GDP. Here's actual. This is the previous years, and you see in 2020, after they put the interest rates all the way back down to zero, and you can see here 2021 still going well, and then all of a sudden they think we're going to be down at this level and then slowly come back up this way. I don't know if it's going to be that easy. I think we're going to be dropping a little lower on all these expectations personally, but if that's correct, you can see the market coming back late 2022, I think, possibly early 23. And like I said, this unemployment rate down here, I have a hard time thinking it's going to be staying this low with all these interest rate hikes. And man, that's going to be pretty rough for the Fed to try to balance these two. Especially unemployment rate is still looking strong. That's not good for the future of the stock market right now. We want to see that unemployment rate actually come up. That'll show a weakening of the economy and help the supply demand will be in a better spot. If they're able to keep unemployment at 4% while getting the GDP up this high, as well as doing all the basis points hikes, I'm going to be very impressed. But typically, unemployment rate goes up with a recession, which we're in, and we're probably going into a deeper one here, in my opinion. So I'll be really surprised if they can keep unemployment around 4 to under 5%. I imagine it'll be more like 5.5, 6, maybe 7% coming up. So this is the personal consumption expenditure index, and this is this is what the Fed likes to use instead of the CPI index. This actually tracks what people are actually spending money on. The CPI is more of a basket of goods that they watch all the time. It's always the same goods. The PCE also puts in effect like business expenditure, stuff like that. So the PCE seems to be a better way to be tracking inflation rather than CPI. It just is more broad, as well as in my opinion, it tracks the actual spending a little better than CPI. So you can see here the core PCE inflation. If this graph is correct, if we'd be about peaked right now, and if this starts going down like this says it will, 2023, 2024 are going to be, in my opinion, big bull markets. The market seems to bull rally before the rest of the economy kind of crashes. Definitely, it'll start rallying before the real estate market crashes or a correction. I don't know how bad the real estate's going to hit, but it'll probably hit pretty hard. Guys, here's a real quick comparison I found for us for the PCE versus CPI. So PCE is a lesser known metric, but it uses data from the GDP report rather than the CPI uses it from household survey. The PCE includes costs incurred by health insurances, meaning the companies that are actually giving people health insurance, they're also taken into effect into the cost here compared to just the consumer health cost. So it seems to be a better mix of what's actually going on in the economy. The PCE does all U.S. households, where the CPI does just the urban households, and the PCE is less affected by wide price swings, and the CPI just is more volatile, basically. So here's one more spot I wanted to talk about for the PCE. The PCE price index considers a broader spectrum of goods and services, notably those purchased by all households across the country, to where the CPI accounts only for households in urban settings, like we're talking about. So guys, I was looking through a couple pages here. It says, will the stock market recover in 2022? a stock market recovery chart. I found this pretty interesting. Basically, I read through this. It says that yes, we will recover in 2022. I don't know if this is thinking we'll recover the entire loss of how far we're down. We'll look at that in a little bit, but I think we'll definitely hit a couple bear market rallies here. Hopefully in October, November, and December we'll hit a couple, maybe a 10%, 20% pop off the lows down here. I'm counting on that. Not that I'm counting on it because I won't go broke from it or anything, but I really think that's going to happen. So average bear market up here says lasts about 1.3 years with a cumulative loss of 38%. The NASDAQ is around there. We'll look at that today too. The average bull market lasts 6.6 years and gains 339%. So even if best thing to do right now is just, if you're not sure what to do, just dollar cost average into the SPY, which is the S&P 500. We'll go over a couple of those here soon. But I love this chart here. It just shows all this blue is the bull market. You're making money, and then this is the scary times like right now, these yellow graphs here. That's how long they last compared to the bull markets. All right, guys, so we got destroyed in the market today. I don't know about you. My accounts are all red. Started out okay. It actually dropped down quite a bit after the meeting, popped back up, and then from there, the Dow, which is the least volatile, went down 2.5%. Year to date, the Dow is down 17.5%. So the Dow is not technically in bear market territory right now. I don't think it quite ever hit. You have to hit under 20% to be. So yeah, the Dow never quite hit bear market this year. The S&P 500 also today, same story. Popped down, popped back up, and then from the top down, it went almost 3% loss from the top. Year to date on the S&P 500 right now, we are back in bear market, so we're negative. We're down 20.99%. So under 20% is a bear market. The NASDAQ, which is a little more volatile, that went down 3.24%. And I do have some leverage plays in the NASDAQ as a bull. So that's a big loss for me. That was what? 369. Yeah, about 10, 11%, whatever. The TQQQ probably went down from this point. But that's okay. I'm going to dollar cost average into that until we get even if we get 10, 20% pop, I'll be back in the green on that. And then real quick, the NASDAQ right now is down 24.68. So it was down, let's see, from the lows, we're still at 5.39% from that June 16th low. But overall, we're in bear market, so we're 24% down for the year. And the Russell 2000, you could argue is the most volatile. This one in the NASDAQ. So this went down 2.82. The Russell 2000 is like the small caps stocks. This is down 22.46% this year. I also have some leverage plays in the Russell. The Russell tends to rally at the beginning of bull markets. In the beginning of the bull market, so I put just a little bit of money, like less than 5%. I have in the leverage ETFs for the Russell and the NASDAQ. So, and really quickly, the VIX jumped up 12.9%. If you guys don't know what the VIX is, that's the volatility index. That's basically when the markets go crazy, buying, selling. That'll spike. I actually think that this needs to hit like 30. Above 35.40 one more time to signal the bottom of the market. So I don't think we're at the bottom of the market personally. I do think we'll get a couple bear market rallies though. Guys, I want to look at a couple stocks here. So we got Apple. Apple has been holding strong for the year. That is, let's see, year to date, down 15% compared to some of these other stocks we'll look at here, down much further than that. But today dropped, let's see, roughly 3.77%, and this is aftermarket, this gray area. I'm not sure what you got to do to be able to buy and sell in those things. That'd be like day traders, swing traders would love that. But the Apple stock's down quite a bit. PE still 25.40. It's in my opinion still a little bit overvalued. If Apple drops to like 130, I think that'll also kind of signal the bottom of the market. And I'll be buying Apple at 130. Also want to talk about Meta today. Meta's PE ratio is 11.78. I think Meta's a buy. I've been loading up on Meta down to 142.12. I mean, that's crazy. The top of it was 361.03 to start. I'm not saying that was valued correctly, but from 361 down to 142. Let's see, year to date, down 58%. And like I said, this PE ratio of 11, man, that is you're getting this at a steal right now, in my opinion. I'm not saying might not go lower, but I think it's at a good value right now. So Tesla today down 2.57%. This PE ratio is 108.32. That is ridiculously high. However, for growth stocks, the PE ratio, it's hard to, you're going to pay more for growth rather than like Apple, which still might grow, but it's not going to grow as fast. Meta also probably won't grow as fast as like Tesla might. So PE ratio of 108, that is insane. I think that Tesla will be going up still. Also, it just has tons of upside on it. So I'm not telling anybody they should buy Tesla or anything, but at the same time, it's a riskier play, that's for sure. But it's intriguing, and it's held up pretty well. Let's see, we got year to date, it's down less than 25%. So guys, we got PayPal here now. PayPal is one of my biggest holdings for single stocks. I do put most of my money in index funds. Probably 85% of my money is in index funds. So I don't do a whole lot of single stock picking. I do like to look at it though. I do have some of these stocks though. I also have some Amazon. But PayPal, the PE ratio is 52.62. A lot of analysts think that they're going to be growing by like 20% every year for the next like 3 to 5 years. I agree with that. I think, like I said, I'm a portrait photographer. I work for myself, and pretty much everybody pays me with PayPal or Venmo. It just seems to be a growing platform. I know a lot of people feel safe when they use PayPal on the online, like the e-commerce sites. So I'm excited for PayPal. It is down 53.23%. I started buying around here March, probably at $100 or so. I started buying a bunch of PayPal. So hopefully, I think I bought it at a good price, right at 100. I am down a little bit, about $9 a share, but I do think there'll be some upside here. PayPal, let's see, the 52-week high was basically 280. So if we can get that, I'll probably start once it gets to like 150. I'll probably start selling some of my PayPal shares. I'll keep some, but I'll start slowly getting out of it, take my profit. I just think that some of these individual stocks have a better upside than like a NASDAQ or S&P 500. The S&P 500 and those other index funds, those will do well, but they're not going to go up like 80% in like a couple weeks, which I'm not saying PayPal will either, but that'll go up maybe 50% compared to that going up like 20 or 30%. That's why I'm in PayPal, is for that increased chance of going up just like another 10-20% than like the S&P or like a Dow Jones index fund. Guys, Amazon's starting to look good again. I think it's at 118.54. I started buying this when it was under 100, or I'm sorry, under 110. I started buying this stock. It's probably right after the split, so must be right around May. I started buying it. I haven't bought any more because I'm up on the position. It's one of the few positions I'm up on right now. But besides my S&P 500 and other index funds, but PE ratio 106. That is hard to justify based on Amazon's growth potential. If you still think Amazon's a growth beast, then maybe 106 is a good PE ratio. But that is it's a pretty hard sell considering how big Amazon is. It's gonna be hard for them to grow that much. I do have some shares. I think their 52-week high was 188.11. I do still think that they'll hit like 150, 160. The hard part is you never want to bet against Amazon, in my opinion. They're just such I think a well-run company, and they keep expanding the way they're making money too. So thanks guys. If you're still with me, please consider subscribing, liking the video, and leaving a comment down below. Let me know if you're looking at any individual stocks or what kind of strategy you're using for this type of bear market. If you're just dollar cost averaging into index funds, or if you're buying individual stocks, I'd like to know. Thanks a lot, guys. Have a great day.